There we go. Test, test, test. My mic is working. Here we guys. Hey everybody, happy Wednesday. This is the big day we've been waiting for. We're going to be watching to see what happens as far as rate hikes in the next half an hour or so. We should get the announcement, I would say, in the next 15, 20 minutes. And then after that, we're going to be watching the press conference from Jerome Powell to kind of see, are we pausing? Are we going to more of another rate hike, next time? Or if there's going to be no rate hike now. So let's be patient and see how this works out, but it looks like it'll be a lot of fun here. As far as how the market's doing, most cryptocurrencies are fairly down at the moment. Not down a lot, but we see Bitcoin at least up around, 0.3%, so not too bad. We're currently curling around right now, so Bitcoin's trying to make some stronger moves. That's a nice thing to see. Going back over here to the daily chart, we're kind of all over the place. We really are all over the place right now. Technicals aren't holding up just because of what's been going on with all these rate hike news and everybody's kind of trying to figure out what to do. So at this point, you're going to see some volatility either way. We're either going to be closing down below like 27,900 or above, like 29,000 basically. So it should be a fun ride, everybody. Now, back up a little bit here. Again, Bitcoin is not in a really bad spot from where we were just even a few weeks ago. So, take that with a grain of salt, but I'm not really panicked too much. If you guys are day trading right now, you guys are definitely liking which way Bitcoin's going. It's been having this nice reversal, but just be aware if you guys are doing some day trades, it's going to be a fun time out there. Let's go back over here very fast. And hey, Jonathan, happy to see you. And hey, Sovereign Soul, happy to see you guys as well. Hope you guys heard this news coming out of Russia as well today. There was a drone flight. This is something that I thought might have spooked the market a little bit more, but I don't think it did spook the market overall, just because everybody's kind of watching this, what do you want to call it, rate hike news. Maybe because that's what I actually care about. But it says, Russia claimed Wednesday that Ukraine tried to assassinate President Vladimir Putin in an overnight drone attack on the Kremlin. News that drew denials from Kiev and furious demands for retaliation from nationalists in Moscow. This may signalize an escalation in the war coming soon. So just be aware of that. Let's see what's going on here. Should be fine. Okay. Let me know if my stream isn't coming around as crisp. Last night I was having streaming issues here and it was very, very annoying. So if my stream is glitching, please let me know. But as far as Bitcoin's concerned right now, guys, we're hovering just a little bit. Technically, if we want to have some trend lines, we can go back over here. Have one right there. And we're waiting to see some type of breakout or breakdown, whichever one happens first. And you guys can feel pretty confident about trading down on this breakdown or this breakout. If we are to break out, guys, we're probably going to be heading to $33,000. What I've been using so far here is just the simple Fibonacci extension. All right. You can see how we got rejected off of this one right there. Now what we're probably going to be looking for is 31,305. Normally when we break out, we have a pretty good pump for a few days. That'll probably take us up to 32,868, kind of around $33,000. From there, we'll have to see if you kind of extend these lines out. That level of resistance that we were just talking about matches up pretty well with some of the resistance we've seen over here, right? So that's really going to be our next leg where things get a little bit more difficult, really between 32,000 and 33,000 if we do decide to take a breakout off of a pause. Now, if things aren't working out in our favor, of course, things can change. What you're going to be looking for is that next big level of support, which is going to be down here. That's really going to be around 26,481. If we start breaking down from here, then it really comes down to, do you want to be buying this around 25,000? I think there's a large amount of people looking to buy between 25,000 and 25,500. That's what I would want to be buying personally, as long as the economy is not going kaput after this rate hike. We'll have to see how high that VIX wants to go. But let's go over here to the Fibonacci retracements. All right. We have that level of support right here. We also have that level of support right there as well. I think we'll probably break down below this if we do have a breakdown. Unfortunately, just because the stock market's been kind of in a tissy fit over the last few weeks, we've had some things that are moving up, but most stuff after the earnings is coming down just a tad. Some of the big stuff you guys may be watching as the market kind of goes more sideways for the day. You can see today AMD is down 9%. That's not good at all. They're not forecasting some good stuff, and they're in the technology space. That's going to have an effect. You see over here, Estee Lauder, which is basically consumer products, like, who doesn't buy makeup, they're down 15% today. 15%. Things are, definitely getting interesting here. They went all the way back down to the November lows almost. So this is going to be interesting to watch. I didn't think Estee Lauder would have such a bad day that it would actually crumble this much. At worst, I think it was like down like 20%, something like that. So these people are losing a lot of money, and the short flow wasn't even that. People didn't even think this thing was going to be going down. So just keep your eye out. We're seeing some surprises here as far as earnings over the last few days. Anything else that's really drawing my attention? Oh yeah, Starbucks is down 8.5%, 9% today. We're seeing some changes. Now, you do have some stability here as far as other stuff is concerned. You can see Tesla's up a couple percent today. Amazon's up 1%. Google's up 1%. Meta's down a little bit because they're facing a FTC lawsuit. Microsoft's up a little bit. Adobe's down almost 5%. Let's say 4.5%. And again, AMD's down 9%. Nvidia's down 1% off of kind of a twin effect, so to speak, with AMD. We're kind of getting a little bit worried here. Hopefully we want to see this AI rally extended, and it seems like some of those AI big pumps are coming back down just a tad. Hopefully it's just part of a longer consolidation period of which we can break out of, but if not, things will get a little bit more scary here in the short term. Just taking a quick peek here at the NASDAQ, you can see we did get pushed back down out of that resistance zone pretty handily yesterday. We were only able to spend 2 days in it, then pop, we got knocked back down. However, we are very far away from breaking down. Dow Jones, we're not even close to that resistance point anymore. And as far as some of these levels of resistance that we've been talking about, support, you can see we're not even close to breaking down there. Oscillators, on the other hand, I don't know why it's not showing up here. What did I do? There it goes. We are seeing some bearish divergences. That's not good. Bearish divergences always suck. But I guess it's just taking a couple minutes to load. I guess everybody's using it today. You can see some divergence right there. Looks like more of a hidden divergence, but again, it's not something you don't want to be seeing this at this point in time. You want to see us get pumped up. And luckily to date, rate hikes are a good opportunity to push a lot of these assets up to that next level where they could break out. The key here, though, is we have to figure out what exactly they're doing. So it comes out about 10 minutes or so. We have rate hikes coming out. I have CNBC right here ready to go, but I'm waiting until we actually have the announcement, and then from there, we're going to wait and watch for half an hour as Jerome Powell gives his presentation to the press, answers questions, and we're going to know for sure if he's going to be data dependent and maybe we have another rate hike, or if this is the last rate hike. Because at this point, I still don't see him cutting with inflation being this sticky. We've talked about a lot of stuff, but I think the highlight here of one of the things that's been very expensive for a lot of people, where a lot of people understand how expensive it is rent. So, if we were to go over here and look at rent inflation, and I've showed you guys this a number of times, you can see how rent inflation is not going down. It's going up and up and up and up and up. And this is with the overall numbers coming down overall, right? Remember, it used to be like 9% inflation, 8% inflation. Now it's come down to like 5%. Rent inflation is still going sky high. Hopefully we can slow this down a little bit, but this is not what you guys want to see. You want to see rent start to come back down here gradually, not like, don't want to see a crash, but you do want to see rent inflation coming down. Preferably a crash for everyday people, but the system doesn't want to see a crash because of all the what do you want to call it? The debt that's on commercial real estate. Oh boy, a lot of those companies also invest in apartment complexes and stuff like that. That would be a disaster. Imagine all those apartment complexes getting taken over by banks. I would probably find it pretty funny if it wasn't for the people living in them. Probably going to have some issues. But at least here, guys, let's go back over here very fast. Let's get out of all this. 15-minute chart. Let's go daily. Ethereum tried to hold support. Didn't really hold support yesterday. Like I said, this is kind of some wacky stuff going on. Interest rate hikes are just making it a little bit more difficult to really spot some of these moves. But again, we got knocked out of that resistance zone. Now we'll see if we can have some type of reversal. Maybe some type of rectangle, or just we find a bottom here, then break back out. We need to have this breakout, guys, soon, next like 2 to 3 days. Otherwise, we are going to be having this death cross. And while it won't stop us from necessarily going up higher, it does mean we're probably going to have a sharp dip for a buying opportunity before we go higher, if you guys want to play that game. But usually you just want to buy and watch it go up. You don't want to buy, watch it come back down, and hope it comes back up. That's not usually the way of the trader. Okay, as far as everything else, though, guys, you see stuff like Matic, definitely more oversold from those highs compared to a lot of other stuff. AVAX, again, far away. Dogecoin, even far away from those highs we saw before. ADA, a little bit closer. Oh, but ADA is standing on a cliff right here of support. If this thing starts falling, we're going back down to 34 cents and such. Yeah, that's no good at all. Ape token, about to fall off a cliff. Yeah, so basically you guys are seeing a lot of stuff kind of touching that support level as far as altcoins are concerned. Bitcoin itself is actually not in a bad spot. That's the kind of way it goes. Altcoins are definitely more risky than Bitcoin. Who would have thought? At this point, Bitcoin's resting at some resistance. Let me put up those technicals here just so you can see what's going on. There we go. And it looks like we have a few more minutes left. Yeah, CNBC is not talking about anything too important at the moment. Let's pop this up right here. There we go. So, how you guys all doing? Are you guys expecting 25, 50? Let me know in the comments down below. For now, though, we're just chilling out and watching Bitcoin go. We'll see how some of the oscillators react to this. What do we got? Yeah, we got 8 minutes left, guys. So it's going to be a good one. And hey, GT, happy to see you. Hey, Larry Summers. Boyle dropped to 272. I bought another 2,000 shares. Dude, this whole market's been very interesting to watch because oil just plummeted today. I don't know if you guys have been watching oil besides what I show you guys. But if I go over here to watch list, let's go down to oil. Yeah, oil is down almost 4%. Look at this. We're just breaking down again. And that support level was still there for only like a few hours. 8, 16, like 32 hours or so. We plummeted down. I don't know if OPEC's going to cut again. This is absolutely insane. Like the oil markets are pricing in a recession right now. They're not pricing in a good economy. And that's not really what you guys want to be seeing at this point in time. See, and hey Nico, happy to see you back. Hey Michael, pass to say hello, press the like button, working, so see you the stream later. Hey Nico, have a good rest of your day. I know you're probably already back to working, but when you do see this, thanks for coming in. Hey Slimy Jaime, seems like strangles have gotten a lot less profitable in these big announcement days. Why is that? Basically, people are guessing more, and it's just kind of turned into a little bit of a free-for-all in a kind of sense where people are doing more day trades and doing more shorter term trades instead of trying to guess what's going to happen a few weeks out. It seems like, I guess that's the way I've been moving as well, and a lot of my friends have been moving in this space, because normally when you see a breakdown, you want to take that breakdown, but because there's so much more uncertainty about what's going on, you just can't trust anything that you see as far as technical analysis, or I can't. So some of the big news events coming along have been rate hikes, CPI data, Russia-Ukraine war stuff, and right now we've been seeing this AI spike, and then after that we saw, I don't know if you guys saw Chegg. Chegg came out and said like they're losing business to ChatGPT, and their stock fell 50%, and now they're going to try to use ChatGPT to make their systems even better, but their stock still fell down 50%. It is absolutely wild what's been going on. And then on top of that, you see what's going on as far as rate hikes. People are kind of concerned. It's just led to a lot more weird volatility. And then the last thing here is, I forgot what it was, but you get the sense that there's so much news coming out, and the market's reacting more to that news than the technicals that are getting played out. And while I guess that's okay in some senses, some scenarios, it really, for long-term swing traders, it really bugs us out a little bit. Like we had talked about how Apple broke out the other day, and now Apple's continuing to move up a little bit higher, right? But what did I say? I made these notes for members on last Sunday. I was saying, hey, Apple could break out. Let's see what happens here. What did I do this Sunday? No, it was this Sunday. Sorry, this Sunday. Don't swing breakout, only day trade. I would place puts down here if we broke down, but we never did. We never closed. And so what happened? We've been having a terrible time here. Imagine buying some options here that are calls. It went down, then up. It's just been a freaking nightmare here. And you don't want to really deal with those scenarios. And even from a day trader's perspective, this has been a pretty freaking ugly, messy chart. I mean, what do we have? Like maybe one breakdown there, and that's it. We have another opportunity for a breakdown coming up. And we'll see if we take it or not. But this has been a whole horrible looking breakout. And so you just can't trust everything that you're seeing at this point. And it really does suck. And, maybe if I get rid of everything for Apple, and I know I probably shouldn't do that, but let's go over here to the weekly chart. We're dealing with this level of resistance right here. It's just been the biggest pain in the ass, so to speak. But, we'll see what happens. You got some divergences coming along. You can see that we're making higher highs here. I know you can't see because of letters, but we're making higher highs, and we're coming down as far as the oscillators, so it's just not good. Maybe I can just show you guys the MACD very fast. There you go. See how we had that crossover here, which signals that we should be coming down lower pretty soon? Didn't even bother. We soared back up here, And normally when we follow these MACD signals, you can see on the 4-hour chart, look at that MACD crossover right there. Nice, beautiful move. MACD crossover right here before we ended up crashing. Good, good, good. MACD crossover right here. What is this right here? Yeah. Even after that, still had a good move. MACD crossover over here. Still good before the drop off. Over here. This is a 4-hour chart, by the way. Good move, right? Crossover right here. Kind of an antsy move, but it did work out in the end, so maybe a little bit more high risk. But, you know, crossover right there. Move up. You can't even trust those moves right now, and I hate that you can't trust them, so you're kind of just sitting on your hands because we haven't had the breakdown yet. We had to break down the 4-hour chart, but you can see this was an after hours, so nobody's really trading during that time. You kind of have to wait a little bit more, but this has just been a chaotic time for investors, I would say, overall, and there's not much you can do about it except for try to trade the things that kind of live off of this or that kind of feed off of it. Like right now, here's gold. Gold is working out pretty well for people, having these small breakouts after time. Would I be trading gold right now? Probably not. It just be anyway. Because again, this is at a level of resistance right now. You probably want to be shorting this. There's just so much you're just not sure of. Last golden cross we had on the weekly chart was way back over here. That was a good opportunity to buy, but we haven't even had that death cross there. So, you know, even if it did, would the market allow that to happen? And we got 2 minutes left, guys, until we have the announcement here. I'll go back to Bitcoin. I'll put this on the 5-minute chart. You could already see a little bit of a dump coming along, a smaller dump on Bitcoin, just because everybody's kind of antsy about what's going to be happening. And then let's get the oscillator down a little bit. Looks like a little bit of divergence in the 15, but that's not bad. Okay, there we go. And hey, Allen, time 25 or 0, 25, I doubt 50. Some people want 50, but again, I doubt we're going to have 50, yeah. And hey, Knucklebuster, what do you think about Pepe? It looks like it dropped 25% today. It is a very high-risk token. Have fun with it, but don't invest the whole portfolio on it, as far as I would say. It's down currently at 21%. Stonks is down 50%. Very, very high risk here. Very, very high risk. What do I use for my B-roll? Hey, the Dolphin. Normally for B-roll, I will get Envato for a month or two, then download a whole bunch of stuff. But normally it's Envato. I don't know if that's how you pronounce it, but Envato is usually the thing I like to go with. I'm going to do one thing very fast. I'm going to turn up the volume on CNBC so when they start announcing stuff, I can pop it up for you guys. But yeah, usually just Envato. I've gotten other stuff as well sometimes, but usually Envato is usually the one that has the most stuff. Or there's a couple that have, I forget what they're called, Motion AI or something like that. I've used them as well. Let's see. What do I think about? Oh, Pepe, yeah, I just answered that. Doesn't oil go back up in a recession, Mike? It depends on how you look at it, because right now OPEC and the what do you want to call it? Oh, hold on a second here. Fed decision imminent. Let's pop this up, you guys.
Tighter credit conditions is going to have going forward.
Jim, back to you. David mentioned.
I'm gonna push pause a thing for a second while they're talking. But basically, it depends on what the market makers are doing. So, I mean, OPEC, America, what they're doing. Right now, OPEC is trying to raise rates, and you can see the decisions come out. I'm in a little bit of a lag here as far as CNBC, so it looks like the decision was slightly positive, but be careful. This is going to really ricochet around for the next few minutes here. So let's kind of move this around. Let's go to the 1-minute chart, and we can kind of watch to see how volatile this thing really wants to get. And hey, Navati, I'm always happy to stream this for you guys right now. See, and hey, Hiram, dude, I'm always happy to help you guys out and stream a little bit here. You can definitely see we're kind of wonking around at this moment, but damn, they're taking a little bit extra time here on CNBC. I don't know why, but I'm pretty sure some of you guys might have seen it right now if you guys are watching CNBC. Maybe if I go over here to Twitter. Yeah, there you go. Breaking. Federal Reserve raises interest rates by 25 basis points. There we go. I'm going to keep raising rates until you assholes stop trading monkey JPEGs. Oh, geez. It should be coming out here in a second.
You know, use the word yet in their statement to kind of indicate some flexibility about rate hikes or not here.
I'm waiting for them to just
we'll come back to you in just a moment.
Because Steve Leisman has the Fed decision here in just a couple of seconds' time. Will it be that quarter point or something different? Steve.
Federal Reserve raising by 1/4 point, bringing the funds rate up to a range of 5 to 5.25%. The Federal Reserve offering, I guess I would call it strange, somewhat hawkish forward guidance that's less hawkish than the last time around. The Fed saying it is determining whether additional policy firming may be appropriate. That's a change from the prior language that it removed, where it said it anticipates that some additional policy firming may be appropriate. So maybe one way to think about this is it's gone from being pretty sure it's going to hike to maybe it will hike, but it's really looking for a reason to do so. Again, I'm going to repeat that. It's gone from the Fed now saying it is determining whether additional policy firming may be appropriate, taking out language saying that it anticipates that firming will be appropriate.
Hey,
the U.S. banking system, the statement says, is sound and resilient, but tighter credit conditions are likely to weigh on households. The extent and effects of that remain uncertain. Inflation remains elevated. The committee, it says, remains highly attentive to inflation risks. On the economy, just a couple lines. Economic activity expanded at a modest pace. Job gains have been robust, unemployment low, and inflation elevated. So back to you guys to chew over what that statement means. Is it a pause? Is it a
NASDAQ
I don't know what it is, guys. Back to you.
Was it a unanimous vote, Steve?
It was absolutely a unanimous vote. Yes, good question, Tyler.
All right.
Yeah, because we actually had some discussion from former Fed officials saying if they continued to hike, they might pause. Eric Rosengren was one of those people. On your screen is a board of the regional banks, which are still in the green. Obviously, First Republic excepted from that, although the gains are modest. PNC up about 0.1%, U.S. Bank up 1%, M&T a little less than 3%. Let me bring in Bob Bassani and Rick Santelli for some quick blush market thoughts here. Bob, what do you see?
Well, look, it's the phrase determining whether additional policy firming may be appropriate is different than saying some additional policy may be appropriate. That's a lot more indeterminate. And the S&P moved up slightly on that. And so, look, the question is, the market was positioned for a hawkish hike,
meaning
come
back down.
The Fed's going to raise rates, indicate inflation's coming down, but it's still too high, and we'll hike again if needed. What would make the market go up is any kind of a dovish hike. The dovish hike would be, okay, we've had some progress on inflation being made, the bank crisis is slowing lending, and implying somehow they're uncertain about how much more they want to hike. And to that extent, I think this satisfied a little bit of that. What makes this really hard to figure out is just this whole impact of the banking crisis on tighter financial conditions. That seems to be the real issue here. So this bank thing is more from deposit flight into something bigger, about more regulation coming, about tighter credit conditions, particularly in commercial real estate lending. So I think that's really what the market wants to hear. They want to hear that the banking crisis is causing the Federal Reserve to be additionally more cautious than they normally would be. They want to know that the rest of the year nothing is going to happen. And that's, I think, why the market's holding up. The market doesn't want to believe in the hard landing. They want to believe that growth is holding up, their earnings are not getting slashed. That's what we're seeing, but it's all dependent on how the Fed is approaching the second half of the year. So we want to hear more about that banking crisis and how they're dealing with it in the presser.
Okay. Oh, actually, the bond markets are important.
Oh, I think it did. I think, as a matter of fact, if I look to my sources as reflecting the general sentiment within the buy and sell side on the street, pretty much everyone was expecting a 1/4 point. And I think for a bit of a silly reason, actually, because if the Fed didn't deliver what it perceived the market priced in, many would question what the Fed knew that the rest of the street didn't know. I'm not sure I buy into that, but so the short answer is yes, Tyler. And as you look, 2-year note yields have dropped 3 or 4 basis points. 10-year are fairly steady. Fed fund futures, as referenced by January of next year, has moved up just a smidge. Here's the way I would frame it to try to keep it quite simple. For the most part, we're at the end of the line. If the Fed needs to reverse course and ease at some point in 2023, I think they lose a bit of credibility again. You know, the old mantra, Tyler, is don't fight the Fed. Well, let me think. Let's harken back. Fed was buying treasuries in QE. They were buying mortgages. They were keeping interest rates artificially low, and they were paying interest on excess reserves. Then they embarked on one of the most aggressive tightening sequences since the 80s. It should be no shock to what happened to the banks. The fact that it was really continues to make me scratch my head. So now we went from don't fight the Fed to what? Don't fight the Fed, but they switched from QE to QT. How can traders keep up? I think the notion of what the Federal Reserve is locked into is more a function that they really don't like to go back and chew their tobacco twice, and you really can't fine-tune the economy like a carburetor, Tyler. I know it's old school, but, you know, if you turn the gas down so it doesn't quite run as rich and it starts to choke, you crank it back a little bit. You can't do that with the economy. If you over-tighten, it isn't a matter of just going back a half a turn on the screw. What it means is you have to go back and try to save face because you went too far.
Kristen, bitterly jump in here. We've seen the Dow fluctuating somewhat between gains and losses. Everything else looks pretty steady.
Let's get this. Let me turn on the volume in my ears very fast. And there we go. So, guys, 25 basis point rate hike. So far, you guys, make sure to answer the poll question here. The poll question was, will another bank fail if we raise rates again? It seems like a lot of you guys are thinking that another bank is going to fail over the next few months, most likely, next few quarters possibly, and that's going to be a hassle. Now, Bitcoin at this point in time has not been taking the news well. It is lower than lower right now than when the news came out, but not by a lot. That's good. NASDAQ right now, the NASDAQ has come down since the announcement. The Dow Jones is about breaking even since the announcement came, now positive a tad. And you can see SPY is just like the NASDAQ, just kind of, or Dow Jones just booming up a little bit now. So we'll see how the whole market takes it. It's pretty much been a little, not really much activity here. We'll probably see some more activity as we hear what Jerome Powell has to say during his press conference. That press conference is going to start in about 20 minutes or so stick around for that. And then you guys can have a good idea of what to be looking for. But at this point, everything is really flat. Even if I go over here to FinViz, you can see there was volatility, but we're overall pretty flat from where we were just about, a few minutes ago. So not too much craziness happening right now. Let me go over here very fast. Get free tickets for Les Miserables. Oh, no, not free tickets, Fifth Avenue. I was like, ooh, I want to get free tickets to Les Miserables. Okay. Twitter is taking it well, I would assume. Let's see what's talked about right now. Kremlin. I think everybody's still talking about the Kremlin. Oh, okay. Well, if you guys didn't know, this happened earlier today. If I can find it right here. Okay, let's show this very fast. Let's turn this on. Let's have the volume back on. Oh, you guys. Oh, I forgot. Let me turn this off as far as CNBC. There we go. Pop this back open for you guys, and you guys can see a drone go into the Kremlin. It was pretty interesting. Oh, I don't think there's volume to this. Sorry, guys. Yeah, so it wasn't really the biggest of drones, I would say, but you can definitely see something went in there, and because of that, I mean, we don't know how this is going to escalate. We have no idea how this is going to escalate at all, but usually when you see stuff like this, it means that Russia is about to do some shit, so hopefully, oh, I don't even think it hit the target. I think it just blew up in the air beforehand. Because look at those two people over here walking. See that? Boop. I don't even think it hit the building. I think it just blew up in midair. Might have been a faulty thing or something. Or maybe it hit the pole or something. I don't know. Whoever was driving that thing had really bad aim. Whoever it was, but just it doesn't look like it hit anything, but I don't know. And that circle is not pointing at it's the people. Okay, I was like, what the heck is that circle going for? But Ukraine says they had nothing to do with it. We'll see how that goes, but I expect in the next few minutes we'll see like stuff like FOMC start to rise a little bit more. This is a scam probably. Steve out there. And yeah, we're gonna have a meeting here in a few more minutes. Now S&P's actually come back down a little bit here. So again, that volatility, it's not going on our way at this point in time. Dow Jones is starting to come back down. NASDAQ is starting to come back down just a tad. Nothing too crazy, but we are starting to come back down just a teeny bit, okay? And hey, Easy Dupe, after yesterday, how do you think the market will react to the rate hike yesterday? Fell off a cliff for a bit. I would assume we're probably still going to be coming down because what the market needed to see in order to have a really robust green day, in my opinion, was a pause or a rate hike with the definitive, hey, we're stopping now. We didn't get that. What we got instead was something to more of the effect of, hey, we are doing a rate hike today, but we probably, or we might do another rate hike next time. We're looking for a reason to see if we have to do it. So they're looking for a reason basically to have another rate hike. So, and this kind of goes in line of what we saw from that AI call as far as, remember, there was an AI fake Zelensky that called Jerome Powell, and Jerome Powell let spill the beans that they were looking to do another 50 basis points of rate hikes. Today we got 25. The next one would be another 25. So they are looking for that because they really do want to get inflation back down. The market, to me, feels like it would most likely go down at the end of the day, but that could probably be a week or a week and a half after this. Usually when Jerome Powell starts getting up there, the market starts to get a little bit more volatile because everybody's hanging on his every word. Are you really going to pause? What does this mean? What are you looking for? What does this tell you? What is the data telling you? Are you still data dependent? And all these different things, all of his answers make the market kind of go up and down all around. But at this point, it probably is a negative. Because remember, a lot of the assets out there, a lot of the stocks out there, they're all in kind of this bearish technical analysis zone where a lot of stuff is hitting levels of resistance. Earnings weren't the best, but they weren't necessarily terrible. And then you see some things like, bearish divergences, breakdowns. Or poor breakouts. Remember we just talked about Apple? Apple broke out a few days ago, and it's been the ugliest breakout I've seen in a while, which is hence why I said don't swing the breakout, because I just knew it wasn't going to be good. And I didn't know it for sure, but the track record on so much stuff these days, guys, has just been like complete shit. And it really irritates me because I like to see consistency in the market. And my success ratio, so to speak, has been going down while all this extra volatility has been going on. So I've been having to be much more choosy about what I trade as far as swing trades are concerned. And it's been very, very annoying. I'm hoping that we have some breakdowns that are kind of naturally occurring so I can take some puts on them. Because we talked about AMD breaking down and how I wanted to buy some puts on that on Sunday. But what happened? It broke down because of earnings. I don't usually trade on earnings. These earnings were like here, AMD. It's down almost 9% today. Let's go over here to the 4-hour chart. Look at that. Look at that. All of that beautiful move happened after hours. I want to be able to, short this because of a breakdown or something. That breakdown might have occurred like right over here during pre-market hours, but I can't buy options during that time. Go over here to the daily chart, right? There's a breakdown right here. That was worth trading. But after that, you kind of just got stuck as it kind of bounced back up. You see the death cross coming. We may be looking to buy back around between $80 and maybe $76. That may be a good opportunity. But you can see how the divergence for AMD happened right around here. And then we started to come back down into the breakdown. That was pretty nice. See the oscillator. There was no divergence on this one. Yeah, there's no divergence on this one. But yeah, you can see the clear MACD crossover. You might even add a stochastic or something like that. Moving averages were kind of fine at this point, actually. But you can see the breakdown there. It's kind of annoying how it's not working out as much as you would think you would like it to. You don't want to see this kind of stagnation here for a few days. Then you start breaking down. Doesn't really bode well. Google right now looking closer and closer to a breakdown, but we haven't had it yet. Google, like so many things at this point in time, is just at a level of resistance. Right. And we're going to see if we can get a breakout. If we get a breakout, I'll probably try to buy while having a golden cross, which is the 50-day moving average crossing the 200. On the weekly chart, though, you can definitely see that level of resistance right here. We're nowhere close to breaking down here on Google. And I don't know exactly what would actually take us to break down from this. It'd be something bad. Tesla broke down. But what happened? It just took another small leg down. Didn't matter about breaking down, really. We managed to bounce back up, and we'll see if we have a full-on good week where Tesla has a big boom. But, those breakdowns don't really amount to anything. Maybe if I go back over here and just kind of show you something. We're about to have a crossover here on the bearish side for the MACD. That'll be interesting. But, well, let me just find it over here. It'll be easier. Fibonacci retracement. We bounced right off of that one. On the daily chart, though, you can see how he broke down below it, then surged back up. This is a weird market right now. It's like the weekly charts are kind of being more trustworthy. We're still in a downtrend here. Don't get me wrong, but you want to see a little bit more of a clean downtrend or a clean breakout, and you're not really having clean expectations. Meanwhile, Nvidia looks like it wants to break out here, even though you can see on the daily chart it tried to break out, got rejected, even though it managed to kind of get back into that zone. Now we're just trying to stay in this zone to see if we can break above 290 and try to go to $300 or so. Microsoft breakout because of all the stuff going on with AI, which has been freaking awesome. Meta over here looking pretty good. Oh, and that reminds me, you guys know that you guys know that last night I was on ChatGPT and I was able to get that bill. So this is the bill that the Republicans passed because I wanted to go over it with you guys. And we're still a few minutes away from that the press conference here. But I asked it to summarize in detail what the new bill does, the Limit, Save, Grow Act of 2023. This is, how do I say it? Well, let's just talk about it right now. Let's just kind of say what it's going over. It says to cut federal spending. The bill proposes to return funding for federal agencies to fiscal 2022 levels with the aim to limit their growth and spending to 1% for a year. Yeah, I see. It does not list specific cuts, but plans to maintain the Pentagon's budget at the current level. Block student loan forgiveness. This bill seems to block President Biden's student loan forgiveness program, which promises up to $20,000 in debt relief for low and middle income borrowers. It also aims to block a new income-driven repayment plan and prevent the Secretary of Education from implementing future student loan debt relief programs. So that's 2. Number 3 is rescind new Internal Revenue Service funding. The bill proposes to rescind the $80 billion set to go to the IRS over the next decade, which was included in the Inflation Reduction Act passed last year. The purpose of this funding was to help the IRS crack down on tax cheats and provide better service to taxpayers. Again, more questionable. Number 4, add work requirements for safety net programs. So this is like if you're on certain things like food stamps and stuff, you have to be working or trying to find a job, I guess. Repeal green energy tax credits. The bill includes provisions to repeal clean energy tax credits that were a significant part of the Inflation Reduction Act. So again, there. And rescind unobligated COVID-19 relief funds. So I guess if they sent money out but it hasn't been used, take it back. Seems to be what's going on here. So yeah, it should be interesting to see how it all plays out, right? But that bill is not going to be passed by Democrats. It's just not. So Joe Biden and McCarthy are going to have a conversation and just talk about what they can actually achieve. Right now, I think Joe Biden is still in the camp of, I don't have to negotiate. I don't have to do this. I don't have to do that. I think he's going to have to negotiate, to be frank, because Republicans do control a chamber of the House, Congress. And if they don't, it's going to look very bad, I think, for him, because nobody wants to see this default go through. Nobody wants to see the panic in the market if it does go through. So, give it some time. We'll see how they Congress works it out. Ugh, I don't have much faith in them, though. There we go. See, my future for Tesla. Right now, Tesla's making new lows on the weekly chart. It's slowly grinding down. You want to wait for it to have a nice breakout, then you can take that trade up there. And hey, King, not sure if you answered this, but I had to step away for a bit. Do you have any videos on chart prime strategy? Yeah, I have a couple. They're basically on some of the reversal bands and stuff like that, but I do have a few more coming out next week. Basically, for chart prime, I'm using their oscillator a little bit more to do some videos and just kind of show you guys the divergences and stuff like that. And then for them, I wanted to use the automatic pattern tools that they have. Oh, and you guys haven't already, make sure to go check out Chart Prime. They are one of the sponsors of this video. I think I told you guys that a while ago, but just in case I didn't, they have this one right here. They have a smart money concepts one as well. Oh, I forgot I was using a different one. But they basically have a setting here where it's which one is it? Chart prime, oscillators, price action, Oracle. Let me find this one. Signals, overlays, chart prime, oscillator, chart. Oh, sorry, it's right there at the top. Jesus. They have this chart patterns one, and what it does is it makes patterns for you guys. Normally, you can fine tune it the way you want to, but it's a pretty nice thing to have. You can go over here to the settings and kind of change some stuff up, like the sensitivities, pattern maturity, quick formation, whatever, breakouts and things like that. You guys know how I like to have the candle closed in order to confirm the breakout. Some people don't like to see that. Some people just want to, as soon as the breakout, it's a breakout. I think day traders are probably going to like the first one better, but for swing traders like me, we want to see the candle close, even though, maybe on the 4-hour chart, something like that. But yeah, you can even set alerts and everything like that, like double top patterns, no delay, double top, head and shoulders pattern, stuff like that. I'll probably do a video on that myself. What I'm doing starting tomorrow, basically I wanted to actually have this video done yesterday. I already have it recorded as far as this chart patterns one. My throat's been acting up and my chest has been acting up, and it feels like I have a cold, without the symptoms besides having kind of a sore throat and a kind of a scratchy throat. So I'm thinking it's actually just really bad allergies that kind of snuck up on me all of a sudden with all this heat that Washington's been getting. But sometimes when my voice gets raspy, it makes for a terrible video, so I'm trying to figure out how to best do it. But yeah, I have a few strategies and I'll do some more. If you have any questions on the strategies, let me know, because Chart Prime has a lot of stuff here. Let me go over here to the... I got so many things on my chart. I need to clean this up a little bit here. Oscillator, Market Oracle, there we go. You know, it has a whole bunch of stuff here where it gives you opportunities to get in, get out, show you some bearish candles and stuff like this, and how you can kind of fine tune it. The key to using Chart Prime and a lot of these other algorithms, though, is fine tuning it. That's why they always have a lot of stuff in the settings portion of it. Because look at this is Market Oracle. Look at all this stuff you can change. All that stuff, 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 all that stuff. There's always so much you can change. So yeah, I will. I'll make another video like breaking down every single thing here. But it does take some time to getting used to. Most of the time, though, I will use this with something like a 15-minute chart, though. That way you can kind of see more signals. Usually with the swing trades and stuff, because Bitcoin's gotten so much volatile on these really big moves, it becomes a little bit more difficult. So like this is the basic model right here. I might take away this dashboard, but you can see after we broke out above this this trend right here, we had a nice little support band, and then we bounced back up, found support there again. Sometimes for those scalpers out there, that was a really good opportunity for you to trade. You can see some of the bullish candles right here, kind of giving you a signal. Hey, look at that. And then maybe you can add a pattern on there if you will. I like these as well. So you got the bearish one up here, bearish star, but you see this one right here that didn't work out, possible reversal down. I like to scale out just in case in those opportunities, especially if I'm buying down here. A small scale out, not a whole thing. Just in case we do come back down, I have at least locked in some profit, because it is telling you that there's a bearish candle. Like we had a bullish candle right here. We came down a little bit more, but then we popped back up. Possible reversal, you know, like that. And again, you can fine tune all this stuff. I got the really basic setup. Normally what I would say, this is for reversal mode. Sometimes I like to do both, and you'll see this kind of shift up a little bit more here. And what you're going to be looking for as far as those reversals, those trends, and you can see the trends now popping up here. And I usually will like to take away some stuff here. So, I mean, what did I want to do? 12 days. Let's go to a month. Let's just get rid of those for a second. And then basically, you can see a little uptrend right here. At the same time, you're breaking, not breaking out, but close. You could buy right there, kind of scalp a little bit later. Downtrend right here, you know, uptrend right here. Scalpers, the scalpers type of thing on a 15-minute chart, but it's all there. But yeah, I can definitely make a strategy for you guys, or a few, definitely a few. And Daily Pizza, what do you think about SQQQ? We bottomed out at 28.75 before bouncing its time. In this scenario, we could actually break through it this time, so just be careful with it. Usually when you're in this scenario, it's okay to make the trade just have a stop loss there. I would say the stop loss is going to be fine here. Oh, right now we have Elizabeth Warren talking. We can listen to her very fast.
That's their measure of success, and their measure of success is 2 million people lose their jobs, and statistically speaking, the odds they shoot us straight into recession are really high.
Let's turn to the other aspect of this, which you're working on today, trying to claw back some comp from the banks. I don't know if you heard Senator Kennedy, who was on this, sitting in your chair about 20 minutes ago, and he very clearly said he thought this was a bank mismanagement. So, A, how do you kind of come at that? And B, it's quite obvious, mismanagement or not, that we have a concern about the health of the banks more broadly. You never want the public in that position. How do you stop that concern from metastasizing? Do you support raising deposit insurance limits on payroll accounts or brothers?
So let's start with clawbacks, okay? Because the advantage here, here's a tool where we can better align incentives. And whenever you can get incentives better aligned, it means you're more likely to get the outcomes you want, right? Rather than solely by regulation. So the idea behind clawbacks is to break the cycle where we are now. The folks at SVB Bank and Signature and First Republic, they all came to Congress in 2016 and they said, loosen the regulations, loosen the regulations. Donald Trump ran for president, said, if I get elected, I'll loosen the regulations on these multi-billion-dollar banks. He got elected. They put in regulators who loosened the regulations. In 2018, Congress came along at Donald Trump's request and with help from Democrats and Republicans, loosened the regulations
4 minutes as
even
well
more.
before the speech.
And you know what happened? Exactly what you would predict. The banks then loaded up on risk in order to boost their short-term profits and paid themselves huge salaries, bonuses, stock options. And then when the banks blew up, they kept the salaries, the bonuses, and the stock options. So look at what that means in terms of incentives. If you can get yourself to a position where you're one of the top executives at one of these multi-billion-dollar banks.
How far back would your clawbacks go? I mean,
5
the equity
years.
is zero. So 5
And
years
I'll tell
worth
you,
of their total comp they will have to give back?
I'll tell you why. It's because what the data show right now, GAO report on this, said SVB started pumping its profits by taking on risk and pushing that money out the door to the executives 5 years before the failure. So it's a 5-year look back. You don't have to take it all back if that didn't happen, but at least you've got a 5-year window to be able to say, if you guys started behaving like this, you're going to have to give back that amount that you took. That's the message we need to send to every single executive of every single one of these giant banks.
So I take your point that bank regulations were loosened and regulators had a bit of a hands-off approach. But Mr. Barr of the Fed took a fair amount of responsibility onto the Fed for failing to do what they needed to do to prevent these banks from failing. So it sounds like there probably was adequate regulation, or they could have known what was going on in these banks.
It was bad management.
And done something about it, and yet they didn't.
True.
Right?
True. But what inference do you draw from that? Why was the Fed...
All right, I'll take a break. I don't want to get in trouble with YouTube as far as, doing CNBC and stuff like that. We got a few minutes left. You saw Loki there for a couple seconds. Right now, guys, just a little bit of an update. Bitcoin is down relative to where we started with all this. It's not down a lot. It's just down, okay? So the market is absorbing this quite well. You see the NASDAQ right now absorbing it quite well. We're down relative to where we were, but we're not necessarily in a bad spot. Dow Jones, we're up a little bit relative to where we just were. That's good to see. And we're looking on the 15-minute chart to have a breakout above the 200. The SPY is also up. So it looks like the NASDAQ is taking the brunt of this for some reason. But it seems like overall we should be okay. We're kind of in this more stagnant mode where we're not seeing too much carnage roll through the markets because of this rate hike decision. Maybe they're thinking about different things as far as maybe this is the pause, yada, yada, yada. But at this point, the market is responding, I would say overall, pretty well to this last rate hike that we just saw about a half an hour ago. Elizabeth Warren is still talking at this point in time about the clawbacks and stuff like that. However, the Fed chair should speak here in a couple seconds, and then we'll have an idea of what's going on. He'll make a statement, then he'll answer questions from the press, and then once that happens, I'll be bringing that up to you guys live. At this point, though, I'm still watching Warren talk with her hands, which isn't a bad thing. It just looks weird when she does it. But yeah, so we'll see. But yeah, not a bad thing, everybody. We're seeing everything kind of go up a little bit here. Bitcoin's down and the NASDAQ's down, but the Dow and the SPY are up a little bit more. They should finish up here in the next 30 seconds to a minute, and then we'll be moving on to Jerome Powell and his speech. Just so you guys have a clear idea of what's going on, Bitcoin's down about 0.5% right now. The NASDAQ's up about 0.5%. Dow Jones up about 0.1%. SPY is up 0.4%. Ethereum's up 0.75%. We're looking okay. One thing here that's interesting is you see the dollar index. The dollar index came down hard afterwards. 4-hour chart. The dollar index may be looking to break down here. If the dollar index breaks down, this is going to be a wild time for the markets. They now have the podium up for Jerome Powell, but he has not walked out. When he does walk up, I will put the screen on for you guys as well. And Powell time, yes it is. I'm excited to hear what he has to say. Now up to 5.25% rate. But you guys can see this right now. Dollar index is about to break down here, it looks like, unless something really crazy happens tomorrow. And if that's the case, the dollar is probably going to go back down to 99 bucks or something, 99.37, or all the way down here to 97. It's going to be interesting to kind of watch how this plays out. I'm excited to see how this plays out, actually. Anything really moving a lot. Some of the stuff we've been talking about is Pepe. Pepe is having a little bit of a rebound right now. Nice little pop. Off of this news. This pop over the last few minutes, though, it's been a 20% pop, This thing is moving up pretty fast, so be careful if you want to chase into this. Stonks is stagnating a little bit. Usually if you see one of these types of plays having a big move, sometimes you can try to get the next one there. So if you guys wanted to play Stonks or Pepe, have some fun with it, but it is a high risk play at this point in time, as you guys know. And we're seeing a pretty good 20% move up from Pepe at this point in time. Not really sure what's driving it. Maybe a tweet, maybe something else going on in the social media sphere, but somebody is trying to inject some life into this, and they're putting down some money in order to do so. And man, Jerome Powell is a little bit late here, it looks like. Luna's down a little bit here as well, down 2.5. XRP is down a little bit more as well, 2.25. Oh, here we go.
Before discussing today's meeting, let me comment briefly on recent developments in the banking sector. Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode and will work to prevent events like these from happening again. As a first step in that process, last week we released Vice Chair for Supervision Barr's review of the Federal Reserve's supervision and regulation of Silicon Valley Bank. The review's findings underscore the need to address our rules and supervisory practices to make for a stronger and more resilient banking system, and I'm confident that we will do so. From the perspective of monetary policy, our focus remains squarely on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 1/4 percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 3 months of the year, job gains averaged 345,000 jobs per month. The unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are coming back into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 4.2%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 5 to 5.25%. And we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We are seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In addition, the economy is likely to face further headwinds from tighter credit conditions.
Yeah, it is.
Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses. In turn, these tighter credit conditions are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will make that determination meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we are prepared to do more if greater monetary policy restraint is warranted. We remain committed to bringing inflation back down to our 2% goal and to keep our longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Gina.
Here we go.
Hi, Gina Smilik, New York Times. Thanks for taking our questions. I wonder if you could tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June. And I also wonder if the Fed staff has in any way revised their forecast for a mild recession from the March minutes. And if so, what a recession like what they're envisioning would look and feel like when it comes to, for example, the unemployment rate.
So, taking your question, of course, today our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting. So the staff's forecast is so. Let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow at a modest rate this year. And I think that's so different people in the committee have different forecasts. That's my own assessment of the most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa. The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives. So broadly, the forecast was for a mild recession, and by that I would characterize as one in which the rise in unemployment is smaller than has been typical in modern era recessions. I wouldn't want to characterize the staff's forecast for this meeting. We'll leave that to the minutes, but broadly similar to that.
Rachel. Thank you, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I'm wondering if you can talk about the account of possible effects of a debt limit standoff. You've said repeatedly that the ceiling must be raised, but do you see any economics effects of even getting close to a default? And what type of situation would that look like?
So I wouldn't want to speculate specifically, but I will say this. These are fiscal policy matters, for starters, and they're for Congress and the administration, for the elected parts of the government to deal with, and they're really consigned to them. From our standpoint, I would just say this. It's essential that the debt ceiling be raised in a timely way so that the U.S. government can pay all of its bills when they're due. A failure to do that would be unprecedented. We'd be in uncharted territory, and the consequences to the U.S. economy would be highly uncertain and could be quite averse. So I'll just leave it there. We don't give advice to either side. We just would point out that it's very important that this be done. And the other point I'll make about that, though, is that no one should assume that the Fed can protect the economy from the potential, short and long-term effects of a failure to pay our bills on time. It would be so uncertain that it's just as important that we never get to a place where we're actually talking about or even having a situation where the U.S. government's not paying its bills. And just to follow up, was discussion around the uncertainty of a possible standoff, did that affect today's monetary policy decision at all? I wouldn't say that it did. It was, of course, it's something that came up. We talk a lot about risks to the outlook, and that come up. A number of people did raise that as a risk to the outlook. I wouldn't say that it was important in today's monetary policy decision yet.
Steve.
Mr. Chairman, thank you. Steve Leisman, CNBC. Can you tell us what the Federal Reserve Board did in the wake of that February presentation where you were informed that Silicon Valley Bank and other banks were experiencing interest rate risks? And can you tell me what supervisory actions you've done in the wake of the recent bank failures to make sure that banks are currently appropriately managing interest rate risk? And kind of part three, but it's all the same question here. Do you still think this separation principle, that monetary policy and supervision can be handled with different tools? Thank you. Sure. So the February 14th presentation, I didn't remember it very well, but now, of course, I've gone back and looked at it very carefully. I did remember it. And what it was a general presentation. It was an informational briefing of the whole board, the entire board. I think all members were there. And it was about interest rate risk in the banks and lots of data. And there was one page on Silicon Valley Bank, which talked about the amount of losses mark-to-market losses they had in their portfolio. There was nothing in it about, that I recall anyway, about the risk of a bank run. So it was, I think the takeaway was they were going away to do an assessment, a horizontal assessment of banks. It wasn't presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of a thing, and I thought it was a good presentation, and as I said, did remember it. In terms of what we're doing, of course, I think banks themselves or many banks are now are attending to liquidity and taking opportunity now, really since the events of early March, to build liquidity. And you asked about the separation principle. Like so many things, it's very useful. But ultimately, it has its limits. I mean, I think in this particular case, we have found that
the monetary policy tools and the financial stability tools are not in conflict. They're working well together. We've used our financial stability tools to support banks through our lending facilities. And at the same time, we've been able to use our monetary policy tools to foster maximum employment and price stability.
Mr. Chairman, I'm sorry. I don't mean to be argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I mean, I didn't say it wasn't alarming. It was they're pointing out something that they're working on and that they're on the case. That I'm not sure whether they mentioned. I think they did actually. They mentioned that they had taken regulatory action, or supervisory action in the form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank, and there are many other banks that are experiencing these things, and we're on the case.
Thank you.
Go to Victoria.
What a good job they did.
Hi, Chair Powell. I wanted to ask you, obviously, with the recent bank turmoil, we've seen multiple banks buy other banks, and I was just curious whether you think that further consolidation in the banking sector would increase or decrease financial stability, and whether you have any concerns about the biggest bank in the U.S. Getting even larger.
So, we certainly don't, and I don't have an agenda to further consolidate banks. Consolidation has been a factor in the U.S. banking industry really since interstate banking, and before that even. It goes back more than 30 years. When I was in the government a while back, I think there were 14,000 banks. Now there are 4,000 and change. So that's going on. I personally have long felt that having small, medium, and large-sized banks is a great part of our banking system. The community banks serve particular customers very well. Regional banks serve very important purposes, and the various kinds of GSIBs do as well. So I think it's healthy to have a range of different kinds of banks doing different things. I think that's a positive thing. Is it a financial? So I would just say, in terms of J.P. Morgan buying First Republic, the FDIC really runs the process of closing and selling a closed bank completely. That is their role, so I really don't have a comment on that process. As you know, there's an exception to the deposit cap for a failing bank. So it was legitimate, and I think the FDIC, I believe, is bound by law to take the bid that is the least cost bid. So I would assume that's what they did.
So, but do you have any concerns about the fact that they're getting larger in general?
So I think it's probably good policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing bank, and I think it's actually a good outcome for the banking system. It also would have been a good outcome for the banking system had one of the regional banks bought this company, and that could have been the outcome. But ultimately, we have to follow the law in our agencies, and the law is it goes to the least cost bid.
Senator Colby.
Thank you. Colby Smith with the Financial Times. At the March meeting, you mentioned that a tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. So given developments since then, how has your estimate changed?
Ooh, good question.
Yeah, I think I followed that up by saying it's quite impossible to have a precise estimate of the words to that effect.
Bad answer.
But in principle, that's the idea. When we've been raising interest rates, and that raises the price of credit, and that, in a sense, restricts credit in the economy, working through the price mechanism. And when banks raise their credit standards, that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a kind of clean translation between one and the other, although firms are trying that, and we're trying it. But ultimately, we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving a sufficiently restrictive stance. But I think conceptually, though, we think that interest rates in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted. But that's what we'll be watching carefully to find out.
Just to quickly follow up, what does it suggest about the scope for the committee to pause rate increases perhaps as early as next month, even if the data remains strong then, if it's having some kind of substitute effect?
This is just something that we have to factor in as we want to find ourselves. So I guess I would say it this way. The assessment of the extent to which additional policy firming may be appropriate is going to be an ongoing one, meeting by meeting, and we're going to be looking at the factors that I mentioned that are listed in the statement, the obvious factors. That's the way we're going to be thinking about it. That's really all we can do. As I say, it does complicate. We have, a broad understanding of monetary policy. Credit tightening is a different thing. There's a lot of literature on that, but translating it into rate hikes is uncertain. Let's say it adds even further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's happening with lending. There's a lot of data on that, and we'll factor that into our decision making.
Howard.
Howard Schneider with Reuters. Thank you. So noting that the statement dropped the reference to sufficiently restrictive, I was wondering, given your baseline outlook, whether you feel this current rate of 5 to 5.25% is in fact sufficiently restrictive.
So that's going to be an ongoing assessment. We're going to need data to accumulate on that. Not an assessment that we've made. That would mean we think we've reached that point, and I just think it's not possible to say that with confidence now. But nonetheless, you will know that the summary of economic projections from the March meeting showed that at that point in time that the median participant thought that this was the appropriate level of the ultimate high level of rates. We don't know that. We'll revisit that at the June meeting, and that's we're just going to have to, before we really declare that, I think we're going to have to see data accumulating and make that, as I mentioned, it's an ongoing assessment.
And a follow-up on credit, if I could you give us a sense of what the SLOOS survey indicated? It was already, I think 45% of banks were tightening credit as of the last survey. What did this one show, and how did that weigh into your deliberations?
So we're going to release the results of the SLOOS on May 8th, in line with our usual time frame. And I would just say that the SLOOS is broadly consistent when you see it with how we and others have been thinking about the situation and what we're seeing from other sources. You will have seen the Beige Book and listened to the various earnings calls that indicate that mid-sized banks some of them have been tightening their lending standards. Banking data will show that lending has continued to grow, but the pace has been slowing really since the second half of last year.
Let's go to Nick.
Nick Tamaros of the Wall Street Journal. Chair Powell, the argument around the end of last year and the beginning of this year to slow down the pace of increases was to give yourself time to study the effects of those moves. After the bank failures in March, as you've discussed, the Fed staff projected a recession starting later this year. So my question is why it was necessary to raise interest rates today, or put differently, if the whole point of slowing down the pace was to see the effects of your moves, and now you've, for the last 2 meetings, been seeing the effects of those moves, why did the committee feel it was necessary to keep moving?
Well, the reason is that again, with our monetary policy, we're trying to reach and then stay at for an extended period, a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time. And that's what we're trying to do with our tool. I think slowing down was the right move. I think it's enabled us to see more data, and it will continue to do so. So we really, we have to balance. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that.
And just to follow up, what you said in response to Howard's question, you'll need data to accumulate to determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intermeeting cycle?
Yeah, I mean, as I mentioned, I would just say that this assessment will be an ongoing one. You can't, with economic data, you can't. You've seen, take inflation from it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down and then come right back up. So I think you're going to want to see that, that a few months of data will persuade you that you've got this right, kind of thing. And we have the luxury. We've raised 500 basis points. I think that policy is tight. I think real rates are probably that you can calculate them many different ways, but one way is to look at the nominal rate and then subtract a reasonable estimate of let's say 1-year inflation, which might be 3%. So you've got 2% real rates. That's meaningfully above what most people many people anyway, would assess as the neutral rate. So policy is tight, and you see that in interest-sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think you feel like we may not be far off, or possibly even at that level.
Yeah, he definitely has an ego right now. I think we need to get back to 2%, but I don't think we need to get back to it anytime
Edward Lawrence
soon.
with Fox Business.
Because if we have a
So if
roaring
the Federal
economy
Reserve
going,
gets down to the
inflation's still coming down,
inflation as the projections show at the end of this year, or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
I think we're always going to have 2% as our target. We're always going to be focusing on getting there.
But would you be okay with a prolonged 3%?
You know what? It's let me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. I mean, that's not a question that's in front of us, and it would depend on so many other things. But ultimately, we're not looking to get to 3% and then drop our tools. We have a goal of getting to 2%. We think it's going to take some time. We don't think it'll be a smooth process.
My bad, guys.
And I think we're gonna need to stay at this for a while.
How does the other side of the mandate, the job side, once you get to 3%, going from 3 to 2, how does the other side of the mandate balance?
I think they will both matter equally at that point. Right now, you have a labor market that's still extraordinarily tight. You've still got 1.6 job openings, even with the lower job openings number, for every unemployed person. We do see some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment. Wages, you all will have seen the wage number from late last week, and it's whenever it was, and it's a couple percentage points above what would be consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments, but the labor market is very, very strong. Whereas inflation is running high, well above our goal, and right now we need to be focusing on bringing inflation down. Fortunately, we've been able to do that so far without unemployment going up.
Matt. Hi, Chair Powell. Matthew Boesler with Bloomberg News. So many analysts noted at the time of the March FOMC meeting that at least half of Fed officials' projections did imply or seem to imply that a recession was in their baseline forecast as well, given the strong first quarter GDP tracking estimates. And so I'm just wondering if you could kind of elaborate on, why you're optimistic that a recession can be avoided, given that that's the Fed staff's forecast, possibly also the broader committee's forecast as well, and also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the Summary of Economic Projections and all that. I don't think you can deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number. Anyway, in any case, I'll just say I continue to think that it's possible
he didn't like the question.
That this time is really different. And the reason is there's just so much excess demand, really, in the labor market. It's interesting, as we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%. pretty much where it was, even lower than where it was when we started. So job openings are still very, very high. We see by surveys and much evidence that conditions are cooling gradually, but it really is different. You know, it wasn't supposed to be possible for job openings to decline by as much as they've declined without unemployment going up. Well, that's what we've seen. So there are no promises in this, but it just seems that to me that it's possible that we can continue to have a cooling in the labor market without having the big increases in unemployment that have gone with many, prior episodes. Now that would be against history. I fully appreciate that. That would be against the pattern. But I do think that the situation in the labor market with so much excess demand, yet wages have been moving down. Wage increases have been moving down, and that's a good sign, down to more sustainable levels. So I think it's still possible. I think the case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is. I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
The committee also noted in March that wage growth was still well above levels that would be consistent with 2% inflation. Do you see that as well? And could you kind of explain, how you come to that judgment?
Sure. So we look at a range of wage measures, and then that's a nominal. And then so you assume wages should be equal to productivity increases plus inflation. And so you can look at the Employment Compensation Index, average hourly earnings, the Atlanta Wage Tracker, compensation per hour, basically those four and many others, and you can look at what they would have to run at over a long period of time for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. Later in an expansion. So yeah, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with inflation over a longer period of time. By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that that wages are really the principal driver, because I don't think that's really right.
Great. Chris Rugaber at Associated Press. Well, you mentioned profit margins. Those have expanded, did expand sharply during this inflationary period. And while there are some signs that they are starting to decline, many economists note they haven't fallen as much as might be expected, given that we're seeing at least some pullback among consumer spending. So speaking of causes of inflation, do you see expanded profit margins as a driver of higher prices? And if so, would you expect them to narrow soon and contribute to reduced inflation in the coming months?
So higher profits and higher margins are what happens when you have an imbalance between supply and demand. Too much demand, not enough supply. And we've been in a situation in many parts of the economy where supply has been fixed or not flexible enough. And so, the way the market clears is through higher prices. So I think as goods pipelines have gotten, back to normal, so that we don't have the long waits and the shortages and that kind of thing, I think you will see inflation come down, and you'll see corporate margins coming down as a result of a return of full competition, where there's enough supply to meet demand, and then you're really back to full competition. That would be the dynamic I would expect.
Paying attention, kind of not paying attention.
Michael. Michael McKee from Bloomberg Radio and Television. Can you tell us something about what your policy reaction function is, your policy framework is going forward? When you look at the economy at the next meeting, are you looking at incoming data, which is by definition backward looking? Are you going to be forecasting what you think is going to happen? Are you ruling out the rate cuts that the market has priced in?
I didn't catch the last part. Ruling.
Markets have priced in rate cuts by the end of the year. Do you rule that out?
Okay, I got it. So what are we looking at? I mean, we look at a combination of data and forecasts. Of course, the whole idea is to create a good forecast based on what you see in the data. So we're always looking at both, and it will, of course, it'll be the obvious things. It'll be readings on inflation. It'll be readings on wages, on economic growth, on the labor market, and all of those many things. I think a particular focus for us going now over the past 6-7 weeks now, and going forward is going to be what's happening with credit tightening. Are small and medium-sized banks tightening credit standards, and is that having an effect on loans, on lending? And so we can begin to assess how that fits in with monetary policy. That'll be an important thing. We'll be looking at everything. It's, again, I would just point out, we've raised rates by 5 percentage points. We are shrinking the balance sheet, and now we have credit conditions tightening, not just in the normal way, but perhaps a little bit more due to what's happened. And we have to factor all of that in and make our assessment of whether our policy stance is sufficiently restrictive. And we have to do that in a world where policy works with long and variable lags. So this is challenging, but we will make our best assessment, and that's what we'll be thinking.
What about the idea of rate cuts?
Yeah, so we on the committee have a view that inflation is going to come down, not so quickly, but it'll take some time. And in that world, if that forecast is broadly right, it would not be appropriate to cut rates, and we won't cut rates. If you have a different forecast, and markets have been from time to time pricing in quite rapid reductions in inflation, we'd factor that in, but that's not our forecast. And of course, the history of the last 2 years has been very much that inflation moves down. Particularly now, if you look at non-housing services, it really hasn't moved much, and it's quite stable. And so we think we'll have to demand will have to weaken a little bit, and labor market conditions may have to soften a bit more to begin to see progress there. And again, in that world, it wouldn't be appropriate for us to cut rates.
So we're going to have Courtney. This is Payne. MT, 100% right. This is the complicated story.
Courtney Brown
nice
from
call.
Axios.
Nice
I'm curious how you view the role of the overnight reverse repo facility in the context of the current banking stress. Do you think it's contributing to the stress by making it more attractive for money market funds to compete with banks for deposits? And did the committee discuss any changes to the structure of the facility, or do you see that being put on the table in the future? Thanks.
Sure. So we looked at that very carefully, as you would imagine, and it's really not contributing. We don't think now. It hasn't actually been growing. It moved up, it moved down, and then moved back up to where it was. What happened in the when there were the big deposit flows, which by the way have really stabilized now. What happened was institutional investors took their uninsured deposits and put them in government money market funds, which bought paper from the Federal Home Loan Banks and things like that. Over the course of maybe the last year, retail investors had been gradually, as they do in every tightening cycle, they've been gradually moving their deposits into higher yielding places such as CDs and other things, including money market funds. So that's a gradual process that is quite natural and happens during a tightening cycle. What was unusual really was the institutional investors moving their uninsured deposits and spreading them around and things like that. But it doesn't seem to have had any effect overall on the overnight repo facility. That is really there to help us keep rates where they're supposed to be, and it's serving that purpose very well.
Okay, Sarah. Sarah Ewald-Weiss, CBS News. I want to go back to the debt ceiling for a moment. I know you talked about that in terms of fiscal policy, but can you just speak towards what the impact of a default would mean for Americans across the country, the markets, and borrowing?
Yeah, I would just say it's. I don't really think we shouldn't even be talking about a world in which the U.S. doesn't pay its bills. It just shouldn't be a thing. And again, I would just say no one should assume that the Fed can really protect the economy and the financial system and our reputation globally from the damage that such an event might inflict.
Scott.
Thanks, Mr. Chairman. Scott Horsley from NPR. In his report last week, Vice Chair Barr identified a couple of the factors that he thought contributed to the supervisory lapses at Silicon Valley Bank. A policy change in 2019 to exempt all but the biggest banks from strict scrutiny, and also what he called a sort of cultural shift towards less aggressive oversight. You were here in 2019. Do you share that view, and what would it take to get the stronger oversight that you and he said in your release would be necessary?
So I didn't take part in creating the report or doing the work, but I have read it, of course, and I find it persuasive. I mean, I would say it this way. A large bank, not a very large bank, a large bank failed quite suddenly and unexpectedly in a way that threatened to spread contagion into the financial system. I think the only thing that I'm really focused on is to understand what went wrong, what happened, and identify what we need to do to address that. Some of that it may just have been technology evolving, we have to keep up with all that, but some of it may be our policies and supervisory and regulatory, whatever. Well, what our job is now is identify those things and implement them. And that's kind of the only thing I care about is, and I feel like I am accountable for doing everything I can to make sure that that happens.
Evan.
Thank you. Evan Reiser with MNI Market News. Chair Powell, are we in the early stage or nearing the end stage of the banking turmoil among regional banks? And secondly, do you still have a bias to tighten rates? Is that what the statement is saying?
So, I guess I would say it this way. There were three large banks, really, from the very beginning, that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved, and all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period is an important step toward drawing a line under that period of severe stress, okay? I also think we are very focused on what's happening with credit availability, particularly, with what you saw in the beige book, and you will see in the sluice is small and medium-sized banks who are feeling that they need to tighten credit standards, build liquidity. What's going to be the macroeconomic effect of that? More broadly, we will continue to very carefully monitor what's going on in the banking system, and we'll factor that assessment into our decisions in an important way going forward.
Okay, Greg.
Thank you, Fed Chairman. Greg Robb from Market Watch. I just wondered if you've done any reflection on your own actions during this crisis and leading up to it over the since you've been Fed Chairman. I think I've heard you say a couple of times that you deferred to the Vice Chair for supervision. Do you think that was the right way to go about this? And comments on that. Thank you.
Sure. So let me say, first of all, I've been chair of the board for 5+ years now, and I fully recognize that we made mistakes. I think we've learned some new things as well, and we need to do better. And as I mentioned, I thought the report was unflinching and appropriately so. I welcome it, and I agree with and will support those recommendations. And I do feel that I'm personally accountable to do what I can to foster measures that will address the problems. So on the Vice Chair for supervision, the place to start is the statutory role, which is quite unusual. The Vice Chair, it says, shall develop policy recommendations for the board regarding supervision and regulation of depository institution companies, and shall oversee the supervision and regulation of such firms. So this is Congress establishing a 4-year term for someone else on the board, not the chair, as vice chair for supervision, who really gets to set the agenda for supervision and regulation for the Board of Governors. Congress wanted that person to have political accountability for developing that agenda. So the way it works, the way it has worked in practice for me is I've had a good working relationship. I give my counsel, my input privately, and I offer that, and I have good conversations, and I try to contribute constructively. I respect the authority that Congress has deferred on that person, including working with Vice Chair Barr and his predecessor. And I think that's the way it's supposed to work, and that's appropriate. I believe that's what the law requires. And, you know, but it isn't, I wouldn't say it's a matter of complete deference. It's more, I have a role in presenting my views and discussing, having an intelligent discussion about what's going on and why. And, you know, that's my input. But ultimately, that person does get to set the agenda and gets to take things to the Board of Governors. And really, in supervision, has sole authority over supervision.
Just wondered if you had any regrets, or was there anything that, you know, decisions that maybe you regret now in light of what's happened?
I've had a few. Sure. I mean, you know, who doesn't look back and think that you could have done things differently? But honestly, you don't get to do that. Again, my focus is on control the controllable. As one of my great mentors used to always say, control the controllable. What we control now is make a fair assessment, learn the right lessons, figure out what the fixes are, and implement them. And I think that Vice Chair Barr's report is an excellent first step in that, but we've got to follow through.
Hi there, Megan Casella with Barron's. Did the possibility of pausing at this meeting come up at all, and how seriously was that considered? I'm curious if you can give us any color as to whether there were any initial concerns about raising rates again, or what those discussions entailed.
Good question. So
support for the 25 basis point rate increase was very strong across the board. I would say there are a number of people, and you'll see this in the minutes. I don't want to try to do the head count in real time, but people did talk about pausing, but not so much at this meeting. There's a sense that we're much closer to the end of this than to the beginning. That, as I mentioned, if you add up all the tightening that's going on through various channels, we feel like we're getting close or maybe even there. But that's going to be an ongoing assessment, and we're going to be looking at those factors that we listed to determine whether there's more to do.
I'm curious, too, how to interpret that and the changes to the statement. Is the bar higher now to raise rates at the next meeting, or would a strong jobs report or inflation print be enough to push the Fed to tighten again?
I don't want to. I couldn't really say. I just think I think we've moved a long way fairly quickly, and I think we can afford to look at the data and make a careful assessment.
And we'll go to Nancy for the last question.
All right, last question, guys. Last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. You mentioned a few times about the lessons you learned from the banking crisis, that you would learn the right lessons. What are those lessons?
Well, I just would start with something that's changed, really, which is the run on Silicon Valley Bank was out of keeping with the speed of runs through history. And that now needs to be reflected in some way in regulation and in supervision. We know now that we know it's possible. I think no one thought that was possible. No one had. I'm not aware of anybody thinking that this could happen quite so quickly. So I think that that will play through. It will be up to Vice Chair Barr to really take the lead in designing the ways to address that. But I think that's one thing. I guess I would just say that. Then